step off here for audio and let Gavin and Brett take over here, unless they want me to join in their discussion.
No, Scott, we always want you to join in. So
you're always welcome, Scott.
Always welcome.
Yeah.
Always welcome.
Yeah.
Yeah, I mean, do you have any questions for Brett right off the bat, I guess?
Was there a particular topic or that he was going to discuss? I don't know.
We're going to just go through the overall macro and take a look at some of his comments he made recently yesterday, just noting the put-call ratio, and also just taking a peek ahead at some of the key things for next week, I think, is our plan.
Yeah, the put-call ratio is somewhat of an enigma for me. We saw that big aggressive correction. The fact that it didn't really spike last week or a week ago when the market was tanking and we saw it at the lows, it just seemed kind of odd that we didn't get that reading above like 120, 125 at all.
Did we get a reading above 2?
Okay, so there's two things. Let me just clarify. So we got a 137 yesterday at the lows. That was pretty good. But the 10-day cumulative average is over 1.12, which is historically an extreme for the average. So it's been creeping up and sticking around. But that big spike, the spike to 2, you should throw out of your map completely, because I think when it's right off the open, it doesn't carry over the sample size. It's like if 2 people at the open do trades, and somebody buys 2 puts and somebody else buys 1 call, you're going to have a 2-to-1 ratio. So it has to build up enough sample size. So what I imagine happened the other day is when the market gapped up off Netflix earnings and everything, there was somebody who was, way too loaded up and was hoping for a bounce to put on a big hedge. And the second we hit the open, they just put a massive put order in, and it just skewed the whole thing. And it took us, an hour to work that off. But otherwise, it's been creeping up more than you think. I agree. I was waiting for that big spike, especially in the crash. But if you look at the cumulative 10-day, it's at like 1.12, which is historically what it needs to get to. So it's actually kind of there.
Okay, I wasn't aware of that. Yeah, I just found it odd how yesterday was the highest close that I have seen in a while, and it just seemed to come at on that first pullback lower low session off the bounce that we've seen here. Right. It just seemed a little odd, and then I don't know if it was skewed towards expiration today, to try to throw people off a little bit.
Probably part of it.
Yeah, I think there's definitely some mechanic going on there to throw people off and lean a certain way, but yeah, that's it. That's really it. Otherwise, I'm more than happy just to hear about you and Gavin, discuss what you think is with this next couple of weeks with earnings seasons. Is in store for us. What you think, how the market's going to respond, and what levels we should be paying attention to. So,
sure thing.
All right. So I guess we're jumping into that. And Scott, by all means, feel free to jump in and ask any questions. Also, as an early heads up, we're actually going to have Scalp Trader on this afternoon to discuss his Ozarks call. So I'm sure people will be looking forward to hearing that. But in the meantime, we're going to get Brett's thoughts here. And again, Scott, like I said, feel free to jump in. But Brett, let's break into your opening line in today's ETF Daily Notes, which is I find pretty interesting. You said yesterday's slide didn't appear to have a clear and distinct direct catalyst, which certainly points to the existence of a big offer out there that can dominate the tape at any time. That provides quite a lure for shorts to get active. You want to expand on that a little?
Well, so, I mean, one caveat to this entire discussion is I have been sick as a dog for about 3 days now. So I'm trying
Beauty
to
of children, huh?
I've got a bunch of medicine in me right now, and I'm doing the best I can. But and unless I missed something, it didn't seem like yesterday's was a reaction to something in particular, did it? I mean, wait.
The bounce from yesterday?
Yeah, yesterday. I mean, no, the turn, the rollover, and the aggressive sell-off was that. So, I couldn't find a single smoking gun. There were a few things that you could kind of weave into the narrative, but there wasn't one thing it seemed to be directly reacting to.
I definitely have my theory on it, and for me, I think that it was European related. Now, I know a lot of people were jumping on that Mnuchin headline. I don't think him backing out of that Saudi conference was really that big of a deal. I looked at 3 proxies for Saudi Arabia that I'm following: KSA, the ETF, obviously, oil, and SoftBank, which they have a pretty big investment in SoftBank, and the fear is that they would pull back some of that investment money from the tech space. I didn't really see that at play at all. I mean, I suppose you could argue some of the tech selling, but I think that was just the Pavlovian response to what people sell when we get into a mode like that. But
Okay.
if you look at the selling pressure yesterday, it was coming right into the close of the European trading, right around 11:30 a.m. Eastern time.
I totally got you. I'm on board with that idea. The one thing I can't work into it is the euro is at the same price right now as it was before that sell-off.
Yeah, but there just seems to be risk removal that's starting with Europe. I mean, if you just look at, just taking a look at the S&P E-mini chart from overnight, you could see we rallied all through the Asian markets, and then into the open of European trade is when we sold off.
I'm on board with that. I think it's... Yeah,
again, today we had that rollover right into the close of European trade, and that's because over the weekend we're supposed to get that follow-up on that Italian budget. Now, if you look at the bottom of that bounce, Brett, what I was looking at yesterday is certainly that 7,100 level in the NASDAQ played a large part, the 200-day there, and that big buyer that you were talking about a couple of days ago. But one of the more intriguing initial reactions I saw was Deutsche Bank having a pretty big spike on no headlines. So my thinking is this, that it's nuts that the European banks are deleveraging because that spread between the Italian and German bonds are getting too tricky for them, and there's some counterparty risk that's involved within the European financial sector that bleeds itself across global markets. That's what I'm thinking.
Oh, I agree 100% with the narrative that you're presenting. The only thing is I'm not so sure that it was the average person participating in the stock market yesterday was following that narrative as much as maybe I would think they should be. But
yeah.
maybe they are. Maybe that was it. Maybe we got past the European Open and we didn't have some kind of resolution. But I don't know how people were looking for a resolution. They're like, why wait until then to sell? It didn't get worse then, you know? I mean, it's a bad situation.
Yeah, I mean, perhaps there was some
getting worse, but it's not. It didn't just get a bunch worse yesterday midday. I guess
there was some hope about more conciliatory tone than
from the EU.
From the EU
yeah.
and Italy.
That could be.
You know, there might have been a little bit of hope there, but I mean that's just what I was seeing on the tape because you know, and I agree. There's a confluence of issues out there, you know, all weighing down. That's just putting us in a downward trend. So it doesn't take a lot to get us kicking to the downside, I think.
Right. Yeah. One thing that I think is kind of interesting. So last. Like 2 weeks ago, I talked to Jim about looking at the Italian situation. So you see the spread between the Italian yields and the German yields, and that's the most significant and obvious way to look at things. But there's also the spread between the 2003 and the 2014 mint credit default swaps, and the 2014 being the ones that have an extra coverage for redenomination that's not a default. So, in other words, people who purchase a lot of credit default swaps on Italy, the 2014 mint, they are purchasing with the intent to cover themselves against a non-default, but that is a redenomination, versus just purchasing a 2003 standard credit default swap, which would just protect against the default. The idea being the spread between the two gives you a sense of what people are pricing in as the risk of Italy saying, screw it, we're leaving, we're going back to the lira. And that, I think it's kind of interesting that the spread between those two through this whole reinvigoration of this drama hasn't really grown. So, and it's also, I guess less of an effect on Spain and Portugal if you look at CDS there. So it's kind of like, it's like the market is still being complacent about something that looks like I can't understand why.
Well, certainly the spreads in the bonds, they're at multi-year highs, right?
I know that it's hell for the banks, but
yeah,
it just, I can't understand why there's, like, unless there's, like, at the end of the day, people think that we can just see a weak Italy, you know, like, there's no risk of a default, but there'll just be a wider spread now, but it doesn't reflect, like, a spat, you know? I mean, I don't know. Like, being part of the European Monetary Union means there should be arbitrage between those bonds. So, you know, if it's not about, I don't know, if it's not about Italy eventually just throwing in the towel and being part of the EU, then the spread should come back together. So it's just,
one would think, yeah.
It's weird to see those two ideas get out of whack right now.
And perhaps
I don't understand
quickly.
why.
And perhaps quickly, right? On, like, if all of a sudden we come in Monday, which is when Italy has to have their follow-up, and they're like, okay, we came to an agreement. Do you think that, I know in your notes this morning you had pointed out that the increase in the budget was 27 times the allowance by rule. Now, in fairness, that's off of 0.1%.
Yeah, okay, but you know what? So, it's still, we're talking, that 0.1 is of billions of dollars. Like, it's still... It's big. It's big in money. It's big.
I got you. I love the sensationalism in it.
But I'm just getting to the point, because that's what the people in Brussels are thinking. Like, they would be pissed about 0.2, and it's 2.7.
Do you think that they did that and hoping to come back and get in 0.5?
I guess so, right? I mean, that makes a lot of sense, because how are you going to stretch it out? But then, again, as my other point is, like, if they give 1 inch, then Spain's going to take a mile, and Greece is going to take a mile, and Portugal, if you start granting exceptions to these rules, it's just mass revolt. I don't see how you create... I
wouldn't be surprised to see France go.
I mean, how long will it take? Imagine, one of the problems in this whole thing that I think people don't usually think about is the on-the-ground reality of having all of these representatives from all these different countries with all these different native cultures and languages having to meet in an EU parliament to work out the rules behind making a change to make an exception for Italy. Like, it's got to be the slowest moving body mankind has ever produced, the EU parliament. And eventually it's going to come back to a rule-making process if you're going to try to say, well, let's bend the rules for Italy. It's not like you can just get a couple of productive people around a pizza and a beer and come out an hour later with a sensible rule change. It's the height of bureaucracy in the history of the world, and trying to get that exception into some kind of formal designation is like, 6 to 8 months at least. So it's going to be a crazy process. I don't see how, if that's what Italy's gunning for, which seems like you're saying, like you put out a big break of the rule to negotiate a small break of the rule and some kind of exception rule, and then you take it back to the people who voted you into office and say, we said we were gonna soften up Brussels and get a special exception so we can get back on track, and here we delivered it. I mean, that's their win, right? So it seems like such a road to travel and such a tough one. I don't know.
I think adding to that pressure is, of course, we had the recent German regional elections in, I'm going blank on which region it was, but where Chancellor Merkel lost a lot of power, and domestically she's under a lot of pressure because of her immigration policies. So you got to figure domestically too, Germans don't want to see Merkel buckle under this Italian press. So you got the other side with just as much to lose, I think, because if Merkel goes in on this, then she loses even more power on the domestic side, and that definitely would spell a lot of uncertainty for the EU, I think.
Yeah, I mean, it's the perfect storm situation always when we get to these moments in Europe, because Germany's always got the most important hand in the game, and they're also the people who are ingrained to watch out for the rest of Europe trying to take something from them that they don't want to give up, and there's just it's such a perfect situation every time we come to one of these where it's just all lined up to cause the biggest possible hassle for everybody. But yeah.
Okay. Just so you know, Brett, there is a headline now saying that the Italian government may cut that deficit target to 2.1%, which would bring it down to 21 times.
That's the deficit target. Okay. Yeah. Right. Right.
So moving on. What are you seeing in terms of broad market reaction to earnings, and what are you kind of looking for? We've got a huge week of earnings next week. I mean, toss out any big name that you want to out there.
I'm looking for themes. I can tell you what I'm looking for. I'm looking for themes. Yeah. I think that we know that the way that I've looked at this whole earnings season is it's basically the height of the most I think it's the most direct moment of like what I would call second derivative impact of the fiscal stimulus. Like, it's not just about the fact that this is the middle of that window. It's also about this is the height of that confidence. If you look at like consumer confidence and, you know, business confidence and everything, it's the impact causing people to want to make, you know, long-term serious capital investment and et cetera, et cetera, et cetera. That's the quarter we just went through. And that's the quarter where companies are having to come to the table and put their report cards up. It should be cycle highs across the board in everything easily. And the question is, so the market's going to know that. The market's going to know these are going to be great numbers looking back over the last 3 months. And the question is, you know, how does it affect where a company's going to put guidance out and what market premium is going to be for good results? Because I would think that obviously the market is starting to say, okay, everything's been great up until, you know, recently, and we're looking ahead at a situation where there might be a few more obstacles over the next 4 quarters than there have been over the last 4 quarters. And, you know, market's a discounting mechanism, and it's looking to price in the value of those obstacles. And so the market is going to assign a premium to the results that's probably going to be lower than it assigns to the premium than the premium it assigned to results in Q1 or Q4 of last year or Q3 of last year, when all of these good things were price-inable. You know, here comes the tax cuts, and here comes you know, the wave of deregulations, and et cetera, et cetera, et cetera. That's what we're looking ahead to the next 4 quarters as of a year ago. So the numbers weren't as good looking back, but the premium the market attached to it was much better, and we just bubbled on into January. And now we're kind of looking at the opposite situation. The numbers are going to be better, and the market's going to be looking at a few more obstacles coming over the next 12 months. And I think that just how significant that, I would imagine you see a lot of good earnings reports get sold, and how the market kind of weathers that process. And if there is a chance that, you know, we saw, like, I think it was, like Adobe came out just with, you know, upping the ante across the board, including looking ahead. And if we see more reports like that, I mean, it could be that just, you know, the market starts to say, hey, wait a minute, we're worried about nothing. This is still a context where, looking out at least over the next few quarters, things are going to come up way rosier than we were thinking. And so I think that forward outlooks are going to kind of play battle against that discount to good backward-looking results. It's going to kind of be a tug of war. And I guess just looking at see how you see how much ammunition the market has on the good news and how much it doesn't have. So just, you know, looking at the reactions and understanding how companies are starting to paint the forward picture across the board. I'm not looking at any one particular company, really. Just kind of, I like to take a very, you know, bird's eye view of it.
Yeah, that was my next question for you, just because, you know, I was curious. Amazon obviously will be a pretty big name, and the big names across the board, really. But is there any sectors that you're kind of looking at as a tell or anything like that? Obviously, early action today, we had a bounce in staples and utilities, which certainly suggests a more defensive nature for people in general. Now, tech was also up there. They were third on the list. At the moment, as we've seen, it's the XLP, which is the staples, up 1%, utilities up 1%, and the majority of the rest of the spaces have given up their gains and are slipping back to either unchanged for the day. This would include the XLF. Tech's given up a lot of its gains, and then we, of course, have in the negative healthcare, materials, and the industrials. So is there any one sector that you're kind of paying attention to more for a tell on the overall macro?
I would say I look for where the pillars are that would need to be cut out to see the market go through some serious trouble. So the pillars that hold the market up right now, everybody knows there's issues with trade. Everybody knows there's issues with anybody that's really sensitive to kind of hyper-cyclical global industry. But, you know, there certainly shouldn't be anything wrong for very domestically oriented companies right now, right? So if you start to see companies with a lot, like some of the smaller caps, some of the U.S.-focused companies have bad forward-looking guidance, outlooks, etc., then I guess that would be sort of a red flag. I mean, that should be a pillar that's you know, impossible to knock out right now. So the market's going to be okay until its pillars get taken out, and I would think that, and as long as you don't see really, like, we've gone by this narrative, you know, all of the trade war stuff. is theoretically bad, but it hasn't really been manifestly bad.
Right.
For how companies are doing. If it starts to become manifestly bad, then that's another pillar, right? The shift to that, the manifest effects. So I guess, really domestically oriented companies and companies that are particularly affected by the trade war who go from saying, we don't like it, we wish it wasn't happening, to saying we're going to have to seriously cut our, forward guidance.
So are you basically looking at the IWM? Then would you say, is that a fair?
I mean, that's a fair way to look at
you?
it. Yeah, it's a fair way to say here's domestic. So, yeah, I mean that's a, and I mean I probably want to have more conversations with you over the next 2 weeks, like we always do.
Yeah.
Because I get much more insight out of talking with you about the results that we've seen. So yeah, I mean those would be the questions I'm asking you in a week or two.
Yeah, no.
Domestic focused. Yeah, how are we doing? And
always a fun conversation, that's for sure. So hey, I'll tell you what. What are the levels? You can pick the S&P or NASDAQ, whichever one you want to talk about first. What are the levels you're looking for, and what would be some ideal setups? Just theoretically throwing out potential actions that you would expect to see that would maybe have you active.
Let me tell you what I'd love to see. What I'd love to see is 5 days in a row sideways, right inside of the range of today, with gradually declining highs and lows getting very near the 200-day moving average in the S&P. And then
so called that 2775 to 2800 area, basically.
Yeah. What I would honestly love to see, just from who's gonna, how I'm gonna make the most money over the next 2 weeks, is to see good earnings reports and a 5-day long descending triangle with a bear trigger level at the 200-day moving average. That's how I know I'll make the most money. It will be on a short. It will be headed to break the 2700 level. I don't know what will happen after it gets there. I suspect we would put in a more sustainable low on a bigger put call spike at that point. But that trade would probably be the single biggest gumball I could imagine right now.
All right. Now let's talk the NASDAQ then. Pretty much similar action, I would think, that is what you'd hope to see with, we'll call those levels, call it the 7100 to 7300. Would that be fair?
Pretty much. Yeah. I mean, a little bit more of a wild card, but it's not gonna. The S&P will still drive the boat. So, I may play the NASDAQ on the S&P doing what I just described. Even if it's weaker, it may not have the same pattern. Like one of the couple of shorts we had over the last 10 days that were really nice was looking at the pattern in the S&P, seeing a level situation like that, seeing that the NASDAQ was underperforming it coming in, knowing that that's where the more excessive weakness would be. Even though the pattern structure wasn't as easy to identify levels, you still play it off of the setup in the S&P, and you trade the more volatile relative weakness play. But the setup is still really, the market is still really signaling you through what you see in the S&P. I do that quite often, so that was something we did a few times, and maybe both. I mean, a couple times last week it was just you got one on in one, and then you realize the other one looks just as easy. You put it on there, and the two are moving together, and it's just good times. So I hopefully we'll see something like that set up, and then I think you could take it back the other direction. I think that type of move would really kind of put that
little double bottom.
Yeah, maybe undercut that first one. I love that. If we undercut that, we really, because then, once you come back from undercutting the first one, what I hate is when you get down near the first one and you just sit. You don't test it. You sit just above it, and then you turn. That's just painful to me. To not see those orders flushed. To not see, to not feel like, okay, we've already gone through the levels where all the stops are going to be. I know all the weekends have already been cleared off the bus. Now I can get on the bus driving back the other direction. And if the bus turns around before it's gotten to the bus stop, and doesn't let anybody off, it's just, they're all there still. I don't want to get on a crowded bus. And there's all these weak hands with orders ready to trigger that are just fingers on the sell button who haven't sold, and yet the market's gradually creeping back higher. That's just intellectually painful for me. So hopefully we will flush under that level if we start to set up that type of pattern. That's where you cover. That's where you turn around. A bit like we did in the S&P short and turned around on it when we went under that, was that 2750 to flush out 2730 last week. That was kind of similar. If you look at like a 60-minute chart, it's a very similar pattern too. You know, if you look at the daily chart right now versus a 60-minute from last week, very similar kind of situation. You know, rather than 5 days going sideways, you had, 24 hours or so going sideways with hourly bars. And then, people thought the bounce was on. It wasn't. We rolled back over. We flushed out 2750, flushed out 2740, 2730, 2720. I covered at 2730, turned around, got long at 2720. Hopefully we get that same kind of thing on a slightly larger time frame. That'd be nice.
We might get a test of that 7100 here today, Brett. Since we've been talking,
we're going again right now.
About 54 points in the Nasdaq here.
Yeah, so you can't deny what's happening right now.
So I don't want to say it's white noise because obviously there are important issues. But what are some of the more annoying things that are kind of hurting this hopeful outlook? Because obviously you'd love to see it work its way down to the lows and break without the help of anything. In light of some decent earnings would certainly be positive. What's some of the things that you're kind of trying to block out or that could offset the reasoning for why we're going lower that could change your thinking a little?
It's a tough question for me to understand. Are you saying what negative catalysts are out there that could make me feel like it's not a natural break?
Yeah, if we come in Monday morning, for instance, and we're breaking lower, and it's because Italy, gave the middle finger to the EU and said we're pushing ahead with this or we're leaving, and European markets tumbled, and then we were tumbling on that. Good chance we'd probably test the lows around what we were talking about before, and then we bounced. Would that upset your thinking?
I mean, I would imagine what we would see if it was that kind of situation is a much more obvious spike in the VIX, spike in put call, that sort of thing. In other words, there's a difference between selling and hedging, and it's an important difference to appreciate. You don't insure stuff you don't want to own. So when you see a drop in a market that is usually, let's just say typically, when you see the market chopped down sharply by something like a sovereign debt crisis threat from the EU, typically, especially if it's short-term and around a particular event like the letter response, typically that is accompanied by a swift jump in the VIX and a swift jump in put call. And it's very clearly the market is moving lower because people are using index-based instruments through one form or another to hedge their portfolios because they want to continue to own the stocks in them. So you've got fund managers who own, big fund managers who own, 40, 50 million shares of something like Apple. And, they don't want to go through the process of distributing that. They need hedging to protect against this escalating into some, EU, that Italy does exit the EU. The euro collapses completely, and that's going to hit everything. But they want to not get hurt by that, but they don't want to sell their Apple, right? So that sort of situation usually marks itself out by things like a very rapid climb in put-call ratio and a very rapid climb in the VIX, which the VIX is really just about the same thing. It's about insurance. So if you see that sort of thing, you usually see those sort of signals around it, typically. At the same time, if you have genuine distribution, a real bear market doesn't have those things. People are selling their Apple. That's why the bear market's happening, is because those portfolio managers aren't hoping to insure against those things going down. They're hoping to no longer own them. And there's a completely different kind of mentality. And so you see some of these kind of metabolic and diagnostic indicators have very different personalities during those types of events. So if we see a very headline-driven, now obviously it's going to be a mix because we're in this corrective kind of zone and people aren't really sure what to do, and reality is never quite as cut and dry, black and white as I just described. So if you think of the concepts I just described as sort of ideals, platonic kind of ideals of the situation, you got some mix of it, but those are the directional kind of elements. If you get a sell-off that has no catalyst, we come in Monday and we're just breaking levels, you're probably not going to see the put call spike right away. You're probably not going to see the VIX spike right away. There'll be some because there'll be people who aren't involved in the distribution, but it will be about selling rather than hedging for some kind of event risk. So I think that I will make that determination. To go back to your original question, trying to filter out that noise is probably going to be about looking at those sorts of indicators. We may still have news like that, but we may get a plodding and gradual decline that is characterized by a big, heavy offer that's just always sitting on things, rather than orders going off at the market on the bid, splashing through the bid and a big jump in put call and a big jump in the VIX. So instead of that, orders are going off at the offer. Traders are buying into this just plodding ceiling that's going down on top of everything, and we're not seeing the insurance gauges spike up. Then it's definitely, you want to be on the short side of a market that's behaving that way. So I think you can kind of filter through the white noise effect that you're talking about by just examining some of the other elements of the personality of the move.
All right, building off some of those risk plays too, let's take a quick peek at gold. Now, I know you had a long in it a while back.
Yeah,
you got shaken out, unfortunately, because you had it right. Trust me, as somebody that was trying to short gold and lost money throughout 2013 when Putin was invading the Crimean area.
That was the greatest time. Yeah, I know, it was tough.
Your pain. But what do you see in gold here at the moment? Holding up nicely above that 1220 area, where I know a lot of people were looking up for that next level to get above. And certainly
it held up on the bounce, right?
Yeah.
That's the main thing. Held up on the bounce. If it was a disaster bid, it's getting a little more friendly to me. Try to play it again because it held up on the bounce in equities. So I got that so far.
Would you find yourself, you think, along this if you were shorting the Nasdaq as well to kind of amplify your returns in an attempt for a move lower? Do you think gold would still find that bid, that safe haven bid, or are you just looking at more from like a technical trade?
I don't know the answer to that.
Okay.
I guess I would look at it very independently, and if the setup is something I like in gold, just in a vacuum, then that would be how I would make that decision, I think. Because it's in a period where if I'm right about the larger picture for gold, it's because gold goes through these different ways in which it connects up with everything. Everything else is kind of a little more stable in its meaning of up or down movement, and gold goes through these changes, right? Gold is the most arbitrarily priced market.
Yeah.
It could be $1 an ounce or $1 million an ounce, and you could believe it either way because there's that doesn't have any meaning. The supply is always fixed. It doesn't really mean anything, the price of gold. So it's very arbitrary, and it could become something that moves with stocks or against stocks depending on a lot of other things. And if I'm right in my larger view of gold, it's because it's changing its meaning right now. And so I don't want to put too much on correlations with other markets, too many assumptions, because I'm afraid that I won't actually see what it's doing if I think in terms of reacting to what other markets are doing, if that makes sense at all.
Yeah, no, that makes sense. And I guess along those same lines, too, taking a look at bonds, you're still short your 30-year, right?
Yes, which I would note is down into the teeth of the selling today.
Yeah, that's a position.
Not to the risk parity, guys. Yeah.
That's a position that you're keeping on, I would assume?
Yes.
Any thoughts with regards to rates and bonds?
My only thought is, I've heard a few people say that rising interest rates aren't the reason why equities broke to the downside. I've heard that a bunch of times now. And I would just say it's not the level of the rates that matters. It's the pace of the change of rates. And the pace of the change of rates is the reason why this correction began. It's no doubt about it. It is the pace of change of rates. That was the catalyzing factor that set in motion this shift in the way. Now, there may be a lot of other things that then became the focus of it, but there were a lot of other things for a while, and this really tripped into gear when rates at the long end broke out and had a very sharp move higher. And again, it's the pace of change. It's because all these guys who are managing money, $500 billion or more, where it's correlated through risk parity models with the equities market, if they see an increase in the volatility of rates, with rates going up, bonds going down, that means and that is not directly caused by a huge breakout to the upside in stocks, because that would be the model, right? They move one as a hedge for the other. If equities market is going sideways or tripping slightly down, and then rates break out to the upside, it changes all the risk covariance models, and they have to go to cash. And when you talk about these, there's three possible positions in that type of model: long stocks, long bonds, long cash. And when those risk covariance numbers change that fast, it's about saying, if rates went up this much today, how much might they be up, according to a computer, 20 days from now or 60 days from now? They have to protect against that possibility. So it is the pace of change. It's not about the level that rates are at. It's about the volatility of rates. And when rates suddenly move that sharply, they must raise cash according to the model. And given how big that model has become, and you've talked about like the robo-advisors, those are the same model. All those types of things usually have this robo-asset allocators where, take your 401k, put it in the hands of this app, and it's going to make these decisions. It's doing the same thing. It's recommending cash raising right now because the hedge is not working. And that means you have to have more cash. So you go from 7% cash to 11% cash. But when you're talking about $500 billion, that's a massive hit to the equities market. And that really set in motion that selling we saw the day after the rate breakout. And since then, we have entered into this new process of trying to understand where we really are in the cycle. And I think that, when you start to look at the supply that we have in treasuries coming in next year, and the big corporate debt rollover, and the possibility of no more new fiscal stimulus, and this being a late cycle situation, and maybe the chip cycle being done, and all sorts of stuff, then, you there's a lot of pillars that have gradually become more questionable. And so the market is going through a process of trying to work through that right now. And the question is, can we come up with a picture that says, oh, actually, second quarter of 2019 is probably going to be the best quarter? Is there something new, some new set of catalysts that kind of push that next, you can't miss out on that type of thing? The new tax cut or the new whatever it is. And it's got to find its reasons at this point. But I think that the initial shift was the rate of change in interest rates, which was dramatic, to say the least.
Yeah, no, all great points. So I think with that, Brett, we could close up our conversation for the time being. I know we got the commitment of traders data out. Is there anything that you're going to be searching for in that?
Yeah, I guess oil, right? I mean, what's going on with all this with Saudi Arabia now, which is just crazy. I don't know how to interpret
this. We didn't touch upon oil, so what are your thoughts on crude right here?
Well, if I didn't know anything that was going on in the world and I just looked at the chart, what I said a month ago is that it's in a trading range, and when it gets to 75, it's going to find resistance and roll over, and that's what it did. But I kind of feel like it's kind of cheap for me to say that's what happened, because something crazy is going on there. I mean, obviously with the risk-off mentality, the higher interest rates, looking ahead at possibly growth slowdown and et cetera, like you can work that in. But then at the same time, why aren't we seeing some risk of some backlash from Saudi? There's some risk built into oil prices.
Risk to the upside or downside?
I guess to the upside, right?
I would think to the upside, too,
I haven't even taken the time to think. I've been really sick for the last few days, and really everything's kind of blossomed in that period, but my initial thoughts are like, my initial gut feeling would have been, oh, well, if there's this big fallout in relationships with Saudi around the world, then, their nuclear option is, of course, to cut off oil supplies. And, thunder the price of oil through $120 or something. Just, that's the threat. Not that they're going to do it, but that's the threat implied, I would guess, right?
Yeah.
I mean, they could do that. Like, that's the one thing they can do that can hurt everybody else. Like, if you look at the United States, what can we do? Tariffs on trade, because we're the biggest consumer, and that's our one thing that we can really do. I guess military protection. But Saudis, what they can do is turn off the spigot. And, that would hurt a lot of countries bad, and so that's their leverage point. So I would just think that if we're seeing this fallout, that there would be some kind of premium being built into oil about risk of that. But maybe it hasn't gotten there. I don't know. You've probably been following this more closely than I have, but I just, that would be what my assumption would be, and it just doesn't seem to be acting that way at all.
No, I mean, I would agree with you, too. I mean, you would think that it would be a positive for the U.S. producers, but you do wonder, I mean, emerging markets are getting squeezed by the strong dollar, higher U.S. rates, and then they're getting squeezed on the other side for buying commodities because Iraq's under sanctions, Venezuela's production has fallen off a cliff, and now if you're going to try to curtail the Saudis, I mean, how do you get countries like India and Japan, who rely so heavily on energy imports, to go along with it?
Well, I mean, that all depends upon the leadership in Saudi Arabia being, rational and compassionate.
Meaning how so? I mean, how do you think Saudi Arabia saves face in this entire?
I don't know. I have no idea how to judge their internal psychological motivations. Like, it doesn't seem. I've been back and forth about this guy since the start, like everybody else, and there's been some pretty interesting moves, like getting all the local leaders together and stealing all their stuff. That's his first move. And I don't know what to think of. I don't know all the facts of the situation. It just seems like, it's kind of difficult to make any assumptions here, and then you just look for what the game theory borderlines are, and I would think that, if it just what are the levers that could be pulled. So the game is, looking at a 50-50 chance of any lever being pulled rather than believing that I understand what the percentage probabilities are of pulling any given lever. And if I know that the lever is they could turn off the oil spigot, I'm just curious that maybe the market has reasons to think that there's an extraordinarily, almost undefinably low percentage possibility of that, so therefore there's no point in pricing it in, and maybe that's right. And I just haven't, understood why we know so much about that probability. But it seems to be the case, I guess. Like, this wouldn't be an economic. Obviously, it would be in their long-term worst interest to do that. Maybe that's the main point. Maybe that's all that's necessary is, if they do that, the long-term for Saudi Arabia is, awful. I mean, even if they threaten it over a long period of time, gradually, then all they're doing is essentially like, when you give antibiotics to cattle like crazy, then you just build up the resistance to a disease, or they build up the disease's resistance to antibiotics. Keeping that threat over everybody's head over time will just cause tremendous investment in alternative energy, infrastructure, I guess. So that's really bad too. So I don't know. Maybe the market's exactly right that it's just a non-factor. Maybe that's where you get to when you think it through. That's how it's behaving. We see a pullback in risk assets. We see a pullback in oil. Oil was at resistance. We're pricing in some potential possibility of a lowering of global growth estimates for next year. Oil moves lower. So maybe it's just as simple as that.
All right. Just while we were talking here, Brett, I did go out with a long in the NASDAQ as it's testing that 7,100 level. So risking 15, seeing if we can't get it bounce back to that 7150 area that we were talking about yesterday.
Yeah, right.
So it'll be a quick intraday trade that I'd look to scalp pretty quickly. So, Brett, is there anything we've talked about it all? Is there anything that you think that we missed?
No. Let's regroup on Monday.
Let's regroup on Monday.
A little bit when I get another 48 hours of sleep.
There you go. Well, will you be able to? Will the kids let you?
Oh, man. I don't know. I think you have sick days in that too. It's like it's up to somebody else.
Yeah,
at least a day here.
Yeah, I hear you. Well, thanks for playing hurt today. That's always much appreciated. I can certainly hear it in your voice. But and thanks for all the insight as per usual. I know the subs certainly appreciate it. So you get better over the weekend. Do you think there's anything that you might take today? Or
it's possible. The market's moving a lot, so the market's moving a lot. So I just keep an eye on it, and if it just becomes, I'm interested in patterns where I almost can't not take them because it looks so obvious to me. Yeah. And I can't tell you what that would look like now. I'll just know it when I see it, and then if I see it, I'll put it out.
Perfect. Beautiful. Well, we'll be looking for it, but definitely get better, get a lot of rest over the weekend because next week's going to be pretty busy on the earnings front. We got some of those manufacturing PMI numbers out. We got that Italy decision out. We got a German election at the end of the week. We have a couple of decisions on Italy's debt I think S&P is out October 26th. So some pretty key events on tap for the markets here.
Yes.
All right. Brett, you get better, my man, and I will talk to you soon.
All right. Thanks, Gav.
Okay. Real quick while I got you on, Brett.
You got it.
Spike in the pound here. Some UK is said to drop Brexit demand on Irish border to ease deal. So it sounds like they're moving closer to a potential Brexit deal here. It's something to just keep note of. Any quick thoughts there?
I have been so negligent in Brexit, and almost intentionally so. It was like the one thing where I felt like, to have an edge over other analysis in my understanding of the ins and outs of the Brexit process would be a tipping point that would cause me to lose money by taking so much of my time and energy, that I honestly have been such a behind-the-curve follower of the entire Brexit drama. Just cards on the table, there it is. And so I don't really understand the implications of this. It doesn't seem to have major implications for too much else, which is interesting. I guess that's why I kind of stopped following it too closely, because it doesn't seem to be a roadmap for a possible other exit. I don't think if they go to another exit, I do not believe that they're going to go through the Brexit-based process because it hasn't worked well. So I guess I feel like it just has implications for the UK, for the pound, and that's about it. Maybe I'm wrong, but that's kind of where been my bias. But
I would say financials you could throw in there, given
I can believe that.
How strong of an export that is for the UK, and just the interconnectivity between the UK and Europe, of course.
Yeah, absolutely. And I guess I figure the way that the process is going, it's going to end up with something that's not as bad as people thought when the Brexit vote happened. And at that point, it just becomes kind of, muddling through the details of the situation, where the market's probably more or less figured out what the picture's going to look like. And, I don't know. I mean, obviously there's intraday catalysts all over the place for people who are trading currencies, especially the pound. But yeah, I don't have a tremendous amount to contribute on that.
Okay, no problem. Appreciate the insight. All right. Well, again, Brett, I'll let you get going this time and go grab some rest.
All right, you got it, Gav. Thanks.
Okay, talk to you soon.